Every 9 seconds, an American borrower defaults on their federal student loans. By the time you finish watching this video, another 80 will have joined them. That's not a projection. That's what the Department of Education recorded in 2025. And the wage garnishments are about to start. But the story doesn't start in 2025. It starts in 2019, the last year before the pause. In March 2020, federal student loan payments stopped. Interest stopped. Collections stopped. For 3.5 years, 43 million Americans had a break. Delinquency fell from 16.7% to 2.3%, the lowest level in modern history. For 3.5 years, the system that had been pulling money out of 43 million Americans paused. The math everyone was used to, gone. The pressure, gone. Some Americans started to believe it might stay that way. It didn't. The pause was temporary. And what happened when it ended changed the math for tens of millions of Americans. This is what changed. In August 2023, the federal government launched a new repayment program, the SAVE Plan. Payments based on income, not debt. For the typical American family, 4 people, $81,000 a year, the monthly payment came out to $36. $36. Manageable. Predictable. 7.5 million Americans signed up. Then the lawsuits started. Within a year, several states sued. The plan got tied up in court. The 7.5 million Americans on it were placed in administrative forbearance. Payments paused, but interest still accruing. By 2026, the courts ended SAVE entirely. A new repayment system was passed by Congress to take its place, launching July 1st, 2026. For the same family, 4 people, $81,000 a year, the new monthly payment is $440, 12 times more. Same family, same income, same loan, different system. This is the part nobody warned them about. The math didn't change because borrowers got worse. The payment formula changed. Within months of the on-ramp ending and credit reporting resuming, the data started moving. Fast. That was the payment. This is what the payment took with it. This is the escalator the data calls a pipeline. By the end of 2025, here's where 43 million federal student loan borrowers actually were. 9.8 million in forbearance. Interest accruing. Balances growing. 3.3 million already behind on payments. 3.6 million past 270 days late, technically in default, but not yet recorded. And 5.2 million already in confirmed default. 21.9 million Americans on or near the escalator. 21.9 million Americans. More people than live in the entire state of Florida. And the people in this pipeline weren't who you'd expect. According to the Federal Reserve Bank of New York, older borrowers, 50 and up, are now the most likely to fall into serious delinquency. 3 million Americans over the age of 62 carry student loan debt today, up 71% from 2017. The number of seniors facing Social Security garnishment for student loans is up 540% since 2002. Not the loans for their kids, their own. And the credit damage came faster than anyone predicted. In the first 3 months of 2025 alone, 2.2 million Americans saw their credit scores drop by more than 100 points. On average, 57 points. The typical delinquent borrower fell from near prime, 680, to deep subprime, 580. Most apartment applications require 650. Only 1.2% of mortgages issued last year went to borrowers under 580. 2 million Americans now locked out of homeownership. Not because their income changed, because a number on a screen did. 3 out of every 4 borrowers entering default this year had never defaulted on anything before in their lives. Not on a credit card, not on a car loan, not on a mortgage. 75% of new defaults in 2025 came from borrowers with clean records. The system found a new population. And the system has tools. Tools that don't require a court. When a federal student loan goes into default, here's what the government can do without ever going to court. It can take 15% of disposable pay, what's left after taxes, directly from a paycheck. No hearing, no judgment. A notice in the mail. It can take 100% of any federal tax refund. And in most states, the state refund too. And it can take 15% of Social Security retirement benefits. There's a floor. What's protected, what a senior gets to keep. And that floor is $750 a month. That $750 number was set in 1996. It hasn't been updated since 1998. The federal poverty line in 2026 is $990 a month, which means a senior having their Social Security garnished for a student loan can legally be left with $240 a month below the poverty line. Nearly 500,000 older Americans currently in default are also receiving Social Security. The Department of Education has their addresses. The Treasury has their bank routing numbers. The mechanism is built. What happens to the money is the worst part. Of every dollar the government has historically taken from Social Security to pay off student loans, 71 cents went to fees and interest. 29 cents went to the actual loan. More than a third of older Americans were still in default after 2 full years of having their Social Security cut. The garnishment wasn't paying off the loans. The garnishment was the loan. This is the system that was always there. This is what 23 million Americans are about to walk back into. Every 9 seconds. By now, while you've been watching, 71 more Americans defaulted. 3 out of 4 had never defaulted on anything before this year. They'll start the day tomorrow with 580 credit. They'll finish the year with their wages garnished. By July 1st, when the new repayment system launches, an estimated 17 million Americans could be in distress. 8 million paychecks eligible for federal garnishment. For most of them, the payment they couldn't afford was $36. The pause didn't break the system. The system was always like this. The pause just gave 43 million Americans 3.5 years to forget. Every 9 seconds. That's the math. That's the system.